Good afternoon to everybody. My name is Alan Taylor, and welcome. We're eager to share the results with you today from Maxio and Benchmarkit's recent survey on SaaS pricing model trends and benchmarks. Ray and Benchmark and us collaborated on this survey to reach out to you, the SaaS community, to better understand what trends are you seeing with pricing and contracting to your customers. And we got some really interesting results that we're eager to share. So to kick it off, my name is Alan Taylor. I'm the COO here at Maxio, where I lead our internal operations, our strategy, our pricing, our M&A. I've been in the vertical SaaS industry for about 15 years within finance, go-to-market, investor relations, and corp dev and strategy roles, leading over 20 add-on acquisitions and being part of countless reporting cycles and board meetings where pricing strategy and contracting strategy was a key topic of interest. For those of you who aren't familiar with Maxio, we provide a platform that helps B2B companies grow and garner financial insights through our billing, RevRec, and reporting capabilities. I'm joined here today by Ray Rike from Benchmarkit. Ray, why don't you introduce yourself and tell the team a little bit about what Benchmarkit does?
Hey, Alan, excited to be here. So over 30 years of experience running operations for recurring revenue software companies. And Benchmarkit, we have the broadest, deepest, and most contextualized B2B SaaS benchmarking database. We've collected data over the last 4 years from 25,000 unique SaaS companies, over 1.5 million data points across 24 different benchmarking categories, everything from SaaS financial performance to usage-based billing trends. And we did this with you guys in 2022, and now we just refreshed it at the end of 24, and excited to dig into some of the details and changes going on, Alan.
Yeah, love it. What a great segue. I like that. And, just a plug for Ray and Benchmark. It's fantastic data. We use it internally here at Maxio to better understand how we are performing compared to our peers. And the insights that we garner from Ray's data sets are invaluable. So today, let's talk about the new data set we come up with this pricing model survey, right? We want to hit first on what is the new reality and what is this shift towards usage-based pricing that we are seeing in SaaS, and what impact is it having on businesses? From there, what we want to talk about is who is adopting what kind of pricing model, and then what are the results of that, right? How's that impacting growth rate? How's that impacting net dollar retention? How are people approaching AI with pricing, right? I'm sure almost all of you have either AI in your product or in your roadmaps today. And then finally, we'll talk about some more operational aspects of usage-based pricing and better understanding how are people instituting things like caps to better, provide visibility to their customers on what bills may or may not be? How are people forecasting their usage-based revenue, which I know is very tricky for a lot of us as we enter this new world? And then finally, what's happening with the contract terms that we're seeing, not just with usage-based pricing, but broadly in the SaaS industry? And that's where I found a lot of really surprising insights through this survey. So to jump in, what is this new reality, right? Pricing and billing has always played a pivotal role in shaping how businesses grow, compete, and retain customers. It's not only a great way to obviously monetize your product, but it's a great way to communicate the value that you're providing to your customers and change the conversation to be more focused on value than just a price tag. Pricing and billing have evolved from necessities into key drivers of growth, right? We're all in crowded markets. We all need to find ways to stand out from each other. Pricing and commercial packaging is a fantastic way to do that, both through, like I said, communicating value more appropriately, aligning value to price, and, having newer creative models that can create win-wins for both you and your customers. Like I said, customer expectations are increasing because of this crowded, evolving market. They're expecting us to differentiate from each other. They're expecting competitive price points, and they're expecting some level of flexibility and visibility into what they are being offered for their individual unique packages. They're demanding pricing models that are reflecting their unique needs, as I said, right? Different industries and different verticals have different ways that they receive funding and perceive value. And we as software providers need to make sure the pricing models that we put out there reflect that and reflect the realities of our customers. Pricing models need to be tailored to evolve to these evolving customer expectations, right? While the key drivers of value in these industries doesn't change that much from year to year, right? The viewpoint on pricing models definitely is. As the world is leaning more and more into AI, people have a much better and stronger understanding now of the variability of the costs and values that come with that. And customers are both understanding of that, but expecting of that to align well to the value they're seeing. And then finally, as I kind of hinted on the agenda, this shift is tough, right? In how you run your business, managing the operational complexity of experimenting and commercializing with new pricing models, it's a scary thing, especially when you start talking about transitioning from, as many of you may have, a decade ago, going from license and maintenance to SaaS. We're doing it again. A lot of us are going from SaaS to usage-based pricing. And what we are seeing is a big shift in how people are evaluating the success of their business, managing their business, forecasting their business, and ultimately how they're thinking about margins and customer acquisition in light of this new pricing trend. Ray, before I kind of talk a little bit more about why does this really matter, what else are you seeing in this new reality of the world shifting more and more towards usage-based pricing?
Right. I was at a dinner with 40 SaaS CFOs last night, and AI pricing was a major topic of conversation. And it's like, how do I price it? How do I ensure my gross profits are maintained if I'm paying large language models and I'm not really sure what that cost is going to be? The other thing that we're going to show today, which it didn't surprise me, but it was really interesting findings, is your pricing strategy has direct impact on how you fit into the growth rate cohorts in the SaaS industry, how your net dollar or net revenue retention performs. So pricing is a little bit about your strategic direction, but it's also about what are those performance metrics that your investors are prioritizing and is driving your company enterprise value growth.
Yeah, no, absolutely. And it's a great point, Ray. I mean, at the end of the day, our investors, our CFOs, we're all focused on growth and profitability. And we've just got new tools on how to get there and new ways on how to evaluate the leading indicators that show we're getting there, right? Innovative pricing models are driving higher adoption, higher market penetration, and they can create some really interesting ideas that create win-wins for customers and vendors alike, as I mentioned. Some of that may be scary to CFOs, as oftentimes it's going into new business models that are not, what we used to follow in the playbook of SaaS industries. But what we're seeing is longer term growth benefits on some of these newer and more innovative pricing models. Similarly, the more transparent and agile we can be with how we price, the happier our customers are. It becomes a little bit less about that actual price point and much more about how are you communicating value and providing feedback, not just on how much is, are they using the product and what kind of volume and throughput they're seeing, but truly what kind of value they're receiving. And the more transparent you can be with that and tying that value to price, you enhance trust so much, and you completely reduce that friction of debating whether or not a price point is valid. And then finally, the more and more that we can focus on not just experimenting with these pricing and billing models, but deploying them effectively, we become much more efficient. Renewal conversations and renewal negotiations become a thing of the past. And now suddenly we're streamlined to free up resources for new strategic initiatives that are focused on driving growth and driving the business forward. So let's first talk about pricing model adoption and what kind of pricing models we are seeing with this most recent survey out there in the industry. And what we found really interesting here is 67% of companies in the SaaS industry are now using some sort of usage-based model. Ray, this was shocking to me. It seemed like a really high number. And I'm curious to hear what that looked like a couple of years ago and what you're gleaning from this.
Yeah, and I'll provide a little context around this, because when we did this benchmarking research in 2022, it's right about 50% of companies were leveraging at least one element of usage-based pricing, very much aligned with what Kyle Poyer and OpenView Partners, when they were doing their pricing research, they were at 48%. So we've seen it increase to 67%. But before we go to the next slide, I know exactly what's happened because I've gotten so many outreaches on this. They're at a board meeting. A board member says, well, we're all subscription. Everyone's going to usage-based pricing and their growth rates are better. Their NDR is better. So we've got to introduce some usage-based component to drive and accelerated growth. But if you go to the next slide here, Alan, it's the details that matter, right? And I know this is a little bit of an eye chart, and I'm actually just going to expand it on my screen itself. But when you really break it down, subscriptions with a minimum, the old number of users, old Salesforce model, that's still the number one pricing model out there. Mm-hmm. And then if you look at the usage base, which is bars number 3 and number 4, you'll see that usage-based pricing with no minimum commitment, it's truly pay for what you use. It's only 7% of companies use that as a primary model. 8% of companies are using usage-based with some type of minimum commitment. Hey, you pay me $1 a transaction, you commit to 100,000, and it's 100,000 minimum commitment for the year. So that's 3 and 4. But if you go over to the 15%, which is subscription plus usage-based, that's where companies have a subscription, maybe access to the platform. Maybe it's you got 5 users you paid for, and you also pay for transactions. Maybe it's number of emails sent, or number of documents, or number of contracts sent, right? Kind of the DocuSign model. So it's really important to understand the details of the primary, and then what we're going to show later is how this affects growth, et cetera. So the details matter, Alan.
Yeah, absolutely. And, being involved in pricing heavily myself, these models that are hybrid, as we call them, so subscription plus usage based, or usage with a but you got to be a minimum fee every month, right? That's super attractive, because when you start tying that to a contract term, it is, inarguably ARR, inarguably revenue that you can count on is deferred, and you still get that upside of the usage base. I'd be curious, Ray, in your dinner last night, what were the CFOs saying around the table around how they view these hybrid models versus going all in on usage? Because there's definitely pros and cons to both.
Well, what's interesting is when you're talking to the person in charge of financial health of a company, they have 2 hats. They have the vendor hat, which is they really like the minimum commitment to have predictability and forecastability, right? But they also like the fact that there's value applied to that value-based transaction, which again, what's emails, and they like the growth that provides in the good times. So they want the minimum commitment. They want it based upon a number of transactions or whatever that variable component is, the ability to charge for overage, and then leverage that overage in the next year's contract negotiation to get a larger annual or multi-year agreement. Now, on the buyer side, CFOs hate usage-based pricing. So that's the paradox, right? Because they're like, hey, I know I'm using this product. I know its value. I need to be able to budget. And let's say it's $100,000 a year. Because if we start using it more, or the transactions or number of systems we were using it for transaction management goes up, and I'm hit with a $300,000 annual cost, I can't bear that. So CFOs, and it's something for us to think about as SaaS vendors, they are more interested in predictability of spend over time, though at the beginning, they really love, I only pay for if I'm using it and it's proving value. So it's a paradox.
Totally, yeah. And we'll hit more on some strategies that they're using to get that visibility, later on in this slide deck. And what I find really interesting here in these models of why CFOs are, afraid of usage-based pricing in a lot of cases is being the buyer, right? I mean, for years and years, there were just a handful of things that we paid for on a usage basis. And oftentimes they were seen as core utilities to the business, right? Your AWS bill. I'm sure that a lot of CFOs in the audience here have been surprised by what's come across the wire from Amazon. Twilio, right? So many of us use embedded SMS and embedded messaging with our product, and we know that can spike up and down with usage. But those are core utilities required to run your business and product. What's interesting now is as more and more of the industry and the, call it quote unquote nice to haves are going to usage based, it does create that difficult decision as a buyer of how to, manage that risk and stay within the financial envelope that I'm seeing today.
Hey, Alan, I'm going to add something about usage based. So my wife is a CFO.
Okay.
And our electric bill, we heat the house with electric, went up like 3x in January because it was a cold January. And she's like, I wish I'd have known that we were going to spend this much. I wish you had given us insight into how much we were spending that week and it was really cold, and we could have turned the heat down. Spoken like a CFO.
Absolutely. And we'll talk a little bit more later as well about how transparency is so critical in moving to a model, that is heavily reliant upon usage. The only other thing that I'd add here as well as you think about looking at hybrid models, right? Think about what's going to make the most sense for your buyer. Right? As for example, if you're positioning usage with a minimum, that could make a lot of sense depending on your pitch. However, some might say, well, if you're instituting a minimum fee, you're basically saying there are going to be cases where I'm not getting value and I'm getting charged. That can be a tricky place to be in. That's why I really like the subscription plus usage-based model. Not too different than what we saw a lot in the past of software companies having a platform fee, then a per user license fee on top of that as a way to kind of flatten their curve, right? This is no different. This is no different, and that is providing some, base value related to the core product that you can communicate in some way or another, and then add that usage fee on top. So as we think about transparency, as we think about making sure that customers are understanding the value we're delivering, there are tools that you can use to help, provide some stability for yourself as a seller while also communicating that value and not having customers feel like they're getting stuck in a gotcha when they ended up having a bill with low usage.
Yeah. And just one more thing on this, and
Yeah.
Also we got a question here from Frank, but what we don't have here, and when we do this again in the next 12 to 18 months, outcome-based pricing.
Mm-hmm.
Paying for the value of the actual outcome. Maybe that's a closed ticket or a new qualified lead. We didn't show that here, but we're going to talk about AI pricing. But I did do some research on the side here, and 8% of AI companies are charging on outcome, and that's going to be an interesting trend to watch also in the future.
Yeah, that'll be very interesting, and especially as people are making big promises with agentic AI, right? We want to see those agents producing for us as buyers. So it makes a ton of sense to say, vendor, put your money where your mouth is as a buyer. But as a vendor, wow, you got to believe in your product in order to do that.
Hey, Alan, Frank has a couple of questions. Do you mind if we go ahead and answer those now?
Yeah, please.
Okay, so Frank, you asked a great question. Does usage-based revenue count as recurring revenue? 78% of B2B SaaS companies include variable price-based revenue in their ARR. 78%. I personally recommend against that. I recommend in your income statement, in your general ledger, you have your firm committed subscription or contracted ARR, and below that you have variable recurring revenue. Now, if you want to present to the external world that it's all ARR, that's your decision. But for internal performance metrics, for budgeting and forecasting, you really need to know the difference between my contracted committed ARR and my variable use ARR. So hopefully that helps you, Frank. And by the way, we're going to talk about contract length trends in a further slide, but multi-year agreements are becoming more popular.
Yeah, absolutely. And Frank, that's a great question of, is it recurring or recurring like, right? And I'll echo what Ray said. The more you can segment your revenue lines and how you run and present the business, the better, right? And like Ray said, of course, we're going to want to present that as ARR, right? As you think about what the payments industry does, right? They're very much focused on that total underlying processing volume, then showing the, the outcome being that revenue and positioning that as a recurring stream. We got to think about the usage revenue in the same way. But as it's so important to split it out because you run your business totally different on those two different streams.
Yeah. And now one last thing, sorry to add one more, but I remember when the first time I started reading the Shopify 10Qs and 10Ks, Shopify does a nice job. They split out their subscription revenue and their value-based variable revenue, which is GMV, gross merchandise value. And by the way, I think it's almost 70% of their revenue is GMV. So they viewed that as a positive. So they wanted to expose that to the investment community.
Interesting. Hey, Ray, before I jump to the next slide, this seems like a money slide here for us. Maddie here has another question about how are you defining subscription versus usage-based versus value-based here? Is subscription just the users and platform? And what's funny is we were prepping for this, we had the same conversation about usage versus value. Why don't you talk about how you delineate between those two?
Okay. And by the way, I must say, when you do survey-based research, this is one of the challenges that you have is clear definition that every respondent, we had over 300 respondents here. So subscription is just a standard subscription with number of users is how we define it in the survey. Yep. Usage was some level of variable transaction utilization. A transaction might be an API call, a message, or et cetera. So they might have a subscription that says, hey, access to the platform for 5 users and 100,000 emails a month. That would be the hybrid, subscription plus usage. Now value. Value is such a hard one, right? And I must admit, I don't think we did a wonderful job of ensuring everyone defined this the same, but value was based on something like I'm charging as a percent of payments. I'm charging as a percent of GMV. There's some value to the transaction that's numerical, it's currency, and I charge as a percentage of that. So it's not really usage like a transaction, it's the value of the transaction. So that's how we define value, Maddie.
Totally, exactly. An example to think about is, if you work with outsourced collections, right? You pay them a percentage of what they receive. That's the value versus actual actions and calls they've made. That's the usage.
And Maddie, when we do the next one of these, we're going to have to clearly define outcome versus value, because there's going to be some overlap of those two, if not well defined.
And I'd expect outcomes to grow as we talk about more agentic AI. Now let's talk about what really matters, how that impacts your growth. This slide was, at first surprising, but then a little less surprising as I thought about it, right? And the key takeaway here is you see on that chart to the right, we have, what the growth rate breakout is between respondents that said they leverage a subscription model, a usage-based model, a value-based model, or a hybrid of both, right? Well, what's interesting to me is two things. Number one, on that hybrid model, that is where we're seeing the most outsized growers. 36% of respondents with a hybrid model are growing north of 30%. Amazing. What's interesting though is on usage-based, right? As you start to dig into that also has the highest value of lower growers, with 45% of those growing at less than 10%. I've got a couple of hypotheses, right? One is just thinking, if you're leveraging a hybrid model, you're clearly savvy about your financial strategy and your financials. So it's not surprising to think that if you're leveraging a hybrid model, you're probably a pretty smart organization. You probably got your stuff together and you're driving solid growth through your base. And then on the usage-based model, right? If you're leaning super heavily into pure usage, there's upside, there's also downside. And that's what we're all afraid of, right? And that's where that 45% may be, rearing its head. But Ray, what do you take away from this chart?
Hey, Maxio, you have your Maxio Institute, and you publish your quarterly growth report that's based upon over 2,100 of your real-life SaaS customers and their growth data. And what was really interesting, and something for the audience here to think about, when the SaaS industry went through the correction period over the last 2 years, starting in second half of 22, subscription-based companies' growth rates declined, but it didn't decline nearly as much as usage-based. I mean, usage-based growth rates declined over 50%, like within 3 months, a quarter. That was because other SaaS companies could just shut down the use, and so the vendors' revenue went away. So really important here to still, even though you might want to use a usage-based model to reduce the customer acquisition velocity, to compress it, prove the value, as soon as possible, getting that kind of minimum commitment, whether that's a subscription plus transaction commitment, et cetera, it's going to really help you on your growth rate and your forecastability of your business.
Totally. And really good call out there on the ability for customers to cost control when they're using a pure usage-based model. And I think that's why it's really important as you are going into and evaluating usage-based pricing, figuring out, are you a need to have or nice to have, right? Is it possible to meter down usage, or is it something that is going to grow as the business continues to grow and move forward, right? That's going to be really important for you to understand the risk in, like what we saw with the Maxio Institute. Thank you for the plug, Ray. Check it out, everybody. Is that, when interest rates were going up, a pretty easy way to clamp down was look at tools where, usage is driving, the price we're paying, and look at tools where we can meter that usage without impacting the overall performance of the business. And like you would expect a savvy and effective CFO to do, they did that. So really interesting stuff, and kind of highlights that there are benefits as a buyer as well to looking at usage-based pricing. Now let's look at a derivative here of growth that we are all very focused on as SaaS businesses, your net dollar retention rate, right? And what you're seeing here is a chart where across each model, you're seeing subscription, usage, value, and hybrid. That yellow bar right there represents what percentage of people that were sub 100% NRR that responded fell into each grouping, right? And a couple things that were interesting to me is if you look at the usage-based number, 1/3 of the companies that said they were north of 120% net dollar retention are on a pure usage-based model. Similarly, only 12% of those that are sub 100% NRR were also using a pure usage-based model. To me, what this says is the law of averages prevails, right? You would expect companies leveraging usage-based pricing to have a pretty good amount of confidence in that their customers' usage is going to continue to grow as adoption grows. And what you're seeing here is just that, right? Those usage-based companies have an outsized slice of high NRR, but a pretty small slice of sub 100% due to usage trailing off. So I think as we do get nervous about that situation that I talked about CFOs really clamping down on usage, the data is not showing up that it's really super common. But one thing that's really interesting, and Ray, we were just talking about this, is that's 30%, 33%, 120% NDR, but how do you define when something is an add to NDR versus just a new customer signing up? Because if I start using one widget on month one, then suddenly add 100 in month two, I don't think I'm what is that, 10,000% NRR? That's probably not right. So how would you think about this?
Yeah, it's really hard. I mean, I about 2 years ago tried to analyze a lot of 10Ks, and I found 12 different definitions of how companies were defining and calculating net dollar retention, also known as net revenue retention. And that was when subscriptions were still the rule, right? So really important as you enter your usage-based journey or outcome-based pricing journey to define when does new ARR end and when does expansion ARR begin. So it may be based upon the ramp-up time or your own analysis. So I can't say it should be at 6 months or at 12 months. You define that, but make sure once you define it, it's clearly communicated and represented on your board deck and to your investors, right? And just continue not to change that. So that's the consistency's most important. Now, what companies like Snowflake have done, they use something called a 2-year look-back process. So because they know that they're constantly trying to get more data into their data warehouse and more usage. So they look at, for the customers I have right now, for the past 12 months, what was their recurring revenue compared to months 13 through 24 previously. So they just don't look at now versus 12 months ago. They look at the last 12 months of usage versus the previous 12 months, so months 13 through 24. So look at the 2-year look-back method if you have a heavy growth, heavy usage-based pricing model.
Yeah, I think another thing that you really need to look out for is business seasonality, right? One thing that we do a lot here at Maxio because you really got to balance that real-time feedback of what's happening with the usage versus understanding that there could be some, blips and bops here and there, right? So as part of our pricing, in some cases, we charge based on total bills being processed. And as we know, oftentimes you might say, whoopsie, I missed this bill on the 30th, and now I'm going to send it out on the 1st. Now, if I'm looking at, doubling up transactions in 1 month and halving them the prior month, that might create a little bit of wonkiness, very technical term, in your NRR and ARR metrics. We like to look at like a trailing 3-month average to really smooth that out. And that works for a lot of businesses. However, if you're very seasonal, right, that Snowflake model makes a lot of sense. I used to play in the K-12 education industry, and I would not expect much usage to be happening between the months of June, July, and August when school's out. So if you did a 3-month look back, things would look horrid every Q3, but then suddenly you have a massive NRR in Q4. And that's why what Ray said, right, about defining the way you're, tracking ARR and NRR, tying it to your business model, making it very defensible, and being consistent is way more important than any kind of, quote unquote industry standard. Because I had the same experience when going through an IPO, looking at definitions of ARR and GR and NRR. And what I learned is there is no standard. It's there's a fundamental standard of what you're trying to get at, but the pathway to get there is going to change quite a bit. And, when you start introducing usage-based pricing, you add a new layer of complexity to that.
Though, Alan, I got to give a plug here. The SaaS Metrics Standards Board is trying to define standards. So the audience can go to saasmetricsboard.com and see what the recommended definition of NDR is.
Love it. Love it. Well, let's talk about something else that's become standard in SaaS, and that's AI, right? I'm sure about half the people on this call might have .ai in their email address. And one, age-old debate from when you're launching a new product is, are you going for monetization of that new product, or are you going for adoption of the full platform? Meaning, I have this new AI add-on module. Am I going to charge for it, or am I going to bundle it in and just hope that I get a lot more of the core business? What Ray shared with me is when he did this survey, it was about a 50-50 of, people and how they're approaching it, of being an add-on or included in the standard agreement. And, my 2 cents as I look at this chart, right, you see that there's way more outsized growers when they're doing cost plus pricing or charging AI as an add-on. However, it's been a couple of years since AI has really, overtaken the scene. So how much can we really read into these numbers versus the long-term impact, Ray?
Yeah. So like you said, it's about, so 70%, by the way, so over 300 people participate in this research, 70% have an AI add-on product. So that tells you how important AI is to legacy SaaS. 50% charge, 50% don't charge. And I call this the debate between adoption and monetization, right? If you believe that your AI add-on, maybe it's just putting a prompt front end in front of your financial backend, right? To make it easier to get to data. If your hypothesis is this is going to be key to customer sat and customer retention and over time customer growth, maybe you go after the adoption. If you've got 100 users, getting 90 people to use the AI prompt engine 5 times a week, something like that, right? To kind of validate there's product market fit of your new AI product. So I like adoption. However, right, if you know right away you've done a 3-month beta with 10 customers and they're getting value, then you can go to that, let's monetize it right away, to help goose the growth rate as you see here and goose the net dollar retention. But I've always said this about any performance metric, Alan, it's got to be aligned to your company strategy. So think about what your strategy is for that install base, how you want to treat and monetize them, and your pricing model for AI should follow.
Totally. And I think the other thing that you need to pay attention to as well is willingness to pay, risk you're putting on the business, and how customers might perceive value there. And what I mean by that is, if I'm a system of record and I've got 95% gross retention and I've got 10,000 customers and I've got a really valuable AI, business intelligence solution that I can layer on top, I would say I'm going to go charge for that thing, right? With that kind of customer base and a system of record, my entire business model is going to be predicated on cross-selling and upselling to my existing customers. If I'm a brand new startup, I still have churn in the 15, 20% range. I'm still trying to make a name for myself, right? Maybe not the best idea to charge extra for that, halo feature that you're putting in front of the rest of the business. So again, it's not just a question of what is your financial strategy, but it's a question of, what kind of product you're delivering and where you play in the market.
Alan,
yeah.
We have a question from Jen on
Sure.
NRR. So let's just hit it real quick. And Jim asked about the view of NRR, NDR, by group. So Jim, if you mean group, I think about segments. It is critical as you start to scale, your gross revenue retention and your net revenue retention by segment. Maybe that's your enterprise segment versus your mid-market segment. Or maybe it's your North American customers versus your European customers. So critical to measuring and understanding your NDR and GRR by segment. And one of the things a lot of earlier stage companies miss is sometimes your gross revenue and net revenue retention is the best identifier of the ICP you should double down on.
100%. That's a great call out, Ray. And that's something I've always done, is looked back to NRR to imply what kind of targets my sales team should be focusing on. So totally makes sense. And what I would say is segment, then segment again. And then when you think you're done segmenting, segment again, right? So what Ray was saying, what I would love to do as well is even look within that. What is the GRR and NRR based on pricing model that your customers are paying as well, right? Going down to that true, whether it's SKU or model level, however you codify your revenue streams, but evaluating NRR in all those different cuts, that's what's going to help you be a smarter business. That's what's going to help you align value better to your customers, and that's what's going to help you maximize those metrics in the long run. So popping back ahead, let's talk about some of the tough realities of operationalizing usage-based pricing. How are people approaching caps? So me as a buyer, I'm going to Twilio and I'm saying I'm going to have however many thousand text messages a year or a month, but I don't want to pay more than 20 grand in a month, right? And how many, or beyond that, right? From the other side, as a vendor, I'm going to allow you 20,000 text messages. You got to pay an overage after that. So how are people actually holding to that? Right. We are seeing that, about, call it, let's see, 50% of customers have some form of cap, whether that be a hard cap or you're just completely cut off, or a soft cap where there's an overage. But what we found really interesting here, though, is 40% of those vendors that have that soft cap, meaning if you go over this, you're going to see an overage, they don't actually charge it. And I get it. As CFOs, when you see something come across your desk as a surprise bill, your first reaction is, I ain't paying that. And oftentimes as a vendor, if it's a surprise to the customer, it's a really, really tough conversation to have. But, Ray, again, thinking back to your conversation and your dinner last night, I would love to hear if this came up, because it's always a debate of, do I capture the revenue that I'm, promised in my contract, or do I acknowledge the customer surprise and give relief for long-term relationship benefit?
Yeah. So at a very, very big usage price SaaS company, they said we are renegotiating our contracts sometimes 2 to 3 times a year. In fact, it's become problematic because we provide the real-time usage data to our CSMs and AEs who own the upsell process, and they're going midway through the year and say, hey, you're coming up on 100% of your annual allocation. We need to re-up you, and there's some economic incentive for you to commit to more for the next 2 years, right? Or next 12 months. So that's one strategy. The second strategy is, especially early in the customer relationship, hey, I'm just going to factor that into next year's annual subscription agreement. And then one thing, and it's a long story, but I used to have this issue 25 years ago in a subscription plus usage-based model, which is kind of surprising, but I would give a X% overage. It typically ended up being between 10 and 20%. Hey, you're committing to 1 million transactions. We're going to let you have up to 1.2 million at no cost. But as soon as we get close to you hitting the 1 million, we're going to come back and talk about the current usage trends, the projected trends, and restructure a go-forward contract to factor that in. So it's a wonderful way to be transparent. Let your customer know you've got their back. You've given them a 20% grace, but you have the perfect entrance to do an upsell for the next 1 or 2 years.
Yeah, no, that's a great model if you have them, the great systems internally to track that, and a really engaged CSM team. I know Avalara is a company that did that really, really well and earlier on in their growth journey. And, being able to have those conversations about customer usage directly and how that ties back to the customer financials, it not only shows that you were trying to make sure you're getting them the best long-term deal, but it shows that you understand where they are in their adoption, and you are watching and making sure that they're getting the most out of their product. I do think, though, the most important thing here, whether it's protecting your ability to charge for, that overage, or, creating that opportunity to, say, quote unquote, upgrade to the next tier or restructure the contract, it's really around transparency, right? I think what's the hardest thing, like you said, is when you're waiting on that energy bill at the beginning of February, and you're thinking, oh, January was cold, what's it going to be? And suddenly the bill pops up and it's $100 more than you thought it was going to be. That's not fun. But when you got meters and you're seeing real time, getting warning notices from your electric company to know that a big bill's coming up, you know what? You can do something about it. You're expecting it, and suddenly it stings a lot less, right? So what we found here is about 30% of companies are putting detailed usage data on those invoices, and 40% of companies are billing more frequently than monthly, right? And in my mind, those are 2 different tools that you can use in order to create that transparency. Number one is you can proactively serve up that data, or like with the separate usage reports or self-service billing portals, provide access to that information. Or if you don't have that capability yet, just bill more frequently, right? A lot easier to deal with a surprise on a 1 week bill than a 1 month or a 1 year bill. Yeah. And any thoughts, Ray?
Yeah, well, we're going to dive into a little bit more detail on the next chart also, but the importance of that financial operations infrastructure and a usage-based or outcome-based pricing model is you're going to try to get different departments to use it. Or if you're an API, maybe you first of all had the sales systems, then you had the IT systems, and you have the HR systems, and they might need to bill back internally. So understanding how your customer budgets your product, how they allocate the cost of that. Number one, you're going to be doing them a big favor because you're going to say, well, let me see how I can allocate the usage by department. So when you get that detailed report, you know how much is going to IT versus marketing versus HR, right? Mm-hmm. So think about your billing infrastructure, not as the means to an end to get cash in the door, which it is. It's a critical foundational element today for customer experience and customer satisfaction. And if you make the chargeback and budgeting and allocation model easier for your customer, your retention rates are going to skyrocket in a usage-based world.
Totally. And I found this chart fascinating. 20 are charging for overages either real time or daily. That is, unbelievably lightning quick. I mean, I'm sure we've all been in the same situation that I've been in before, where you're landing on a plane in a foreign country and suddenly you turn your phone on, you get that cell phone usage international data overage bill, right? Seeing that is now coming into B2B SaaS is really fascinating. And I just love the transparency it brings. Now, in the case where I have that cell phone bill pops up, real time, I'm probably calling AT&T the second I get out of that plane to see if they can back that out and change things. And I also think that, having that real-time feedback allows you to have those tough conversations immediately. So now you're suddenly not having conversations about, do I need to credit back revenue after the end of the month? Do I need to layer in the usage fees after the fact? Right? You're just creating less surprises for everybody, yourself included. Right. The other thing, with billing transparency, and we're thinking about it, like, how are people providing that billing transparency? And the takeaway that I found here is that 37% of people are bundling everything into a single subscription line item, which makes disambiguating that usage and that usage infrastructure that Ray was highlighting really, really difficult to track. I can understand why companies are doing this, right? If you're doing usage in arrears, if you're trying to do usage real time without the greatest metering involved, it can be very difficult to, show that. But what I find interesting is we see just about 40% are hiding that usage fee into the subscription. And if I flip back 3 slides, there's about 40% of people that are, not charging when people go over those caps. And that may be a coincidence, but I just find that very interesting to see that, I believe there's some correlation there. At the same time, that is my opinion. That is my, assumption. Would love to hear, think what you're seeing here, Ray, and what you think.
Well, I will go and do that crosstab or that correlation analysis and have the data for you, Alan. But,
love it.
I think here, once again, in the evolution of usage and value-based and outcome-based pricing, your ability to give that transparency is going to be critical to customer satisfaction, right? As we mentioned earlier, the fact that 22% are providing the detail on the invoice is great. The fact that only 6% provide some type of customer portal that can come in. Maybe they download the actual usage by IoT device or by department, et cetera. That's going to be so critical to the future. So don't view your investment in your billing infrastructure as just that way to get cash faster. It really is a way to have higher customer satisfaction. I've said that before, but I'm going to say it again. And if you're going on your usage-based pricing journey, really think about the customer experience first and second.
Absolutely. And third, think about your own experiences. When you drive that customer experience, you get great data that you can use to run your own business. And that's where we get into the scary, scary world of forecasting usage-based revenue, right? You're not looking at a deferred revenue waterfall. You're not applying a simple uplift to what's happening in the next term. You got to understand what your customers' usage, trends are. And what's interesting to me, right? You might first think 73% saying, yes, they are forecasting usage-based revenue as a high number. But if you really think about it, how many of you have revenue streams in your business that you are not forecasting today, right? If this was subscription revenue, I'd expect that yes to be about 95%. So when I see 73%, that is really surprising to me. but I understand it because it's so difficult to forecast usage-based revenue. And as we tab forward, here's why, right? There's so many different approaches that you can use. You can do it based on, how other usage-based pricing companies are forecasting. You can look at historical usage trends. You can even lean on your customers to provide estimates. You can, use customer-provided forecasts and haircut them a bit. Ray, what's your recommendation for how people ought to approach usage-based forecasting? Because there's so many different ways to cut this.
Well, one interesting change over the last 2+ years between the 22 and the late 24 research we did was getting product utilization data in near real time. It doubled, because in 2022, a lot of times people just download the product utilization at the end of the month, get it into the billing system and bill it, right? But now, because they know it's so important for that customer success manager to know how their customer is using the product, to go and either help them increase their utilization or forecast the bill that's going to be coming at the end of the month, et cetera. So number one, have that ability to look at product utilization real time. That's one huge recommendation. Number two, have that in your billing system so you can see how that's going to impact the projected billing. But then you asked a bigger question, and this is, if we go to the next slide, and to me, this is really important. Yeah, you can use historical trends for each customer, right? Because the data's there. Of course, during that QBR, right, you can get a good understanding from your customer and hopefully their executive sponsor of what their business trends are and how that's going to impact the utilization of your product. But having done this a long time ago and getting burnt, external economic factors are really important. If you're selling a usage-based product in a financial services industry and a big part of their usage is mortgage origination, you better understand how the mortgage origination business is trending because of interest rates and factor that as an external variable. Or it's healthcare and what's going on with HIPAA and patient billing. Just understand the external variables and try to model that in and put it into your forecast model, which I know sounds really advanced. Like, Ray, I just got my product utilization information. It's hard enough with that, but you got to start thinking about the external.
You do. And, I think about this, it just follows the tenets of good forecasting for anything, right? I've run a lot of sales teams in my career, and I always triangulate forecasts. I'm not just taking my seller's forecast and adding them up and saying, that's my forecast. I'm not just looking at a CRM or a sales automation tool and taking the weighting and their predictive, score and saying, that's it. I'm not just believing what my VP says, right? I'm looking at how are customers actually committing in those deals? What has actually happened in this seller's patch in the history? What are we seeing more broadly from a macro standpoint on customers, pulling in or pulling out of deals? And it's no different, right? The big takeaway I have here is this is adding up to way over 100%, which says that most companies are using multiple variables in forecasting that usage-based revenue. You can't lean on just one. You got to get really smart. And honestly, that's one of the things that I really love about usage-based revenue, right? As you as a business are transitioning into usage-based revenue, you are forcing your finance team, your sales team, your customer success team, everybody to get much smarter about the businesses that they serve and the way that they perceive value, because you really need to be forecasting not just the dollar amount, but those underlying variables that are driving the dollar amount with your usage-based model. So, as I've hit on, while it is a scary change, the long-term growth benefit is huge, and just up-leveling the organization. That seems intangible, but as a practitioner, I can say the more people you have on staff that understand what is truly delivering value to your clients, that is never a bad thing. This last topic, I found this the most fascinating, right? Thinking about how, what trends are we seeing, not necessarily 100% tied to usage-based pricing, but just broadly, what trends are we seeing in contract term length that we're seeing in SaaS contracts? And to me, intuitively, I would think, what? Everybody's been clamping down. Everybody's focused on free cash flow and EBITDA as a valuation driver now. Got to imagine that people are going to be very, very much focused on flexible contracts. But this was shocking to me. 40% of customers are now, seeing multi-year contracts. Sorry, let me reword that. 40% of the vendors we surveyed are now seeing more multi-year contracts, up from 14% in 2022. And as we start to tab for a little bit more, right, you see a lot of 2-year deals, a lot of 3-year deals, and just less and less 1 year and month-to-month deals. I've got a hypothesis here, and I think it all comes back to predictability based on these usage-based models. So as usage-based pricing goes up, the appetite for multi-year contracts goes up. And as we think back to the comment that we were making earlier about CFOs instituting mechanisms as buyers to create visibility, that's exactly what's happening, right? One of the first things that would come out of my mouth as somebody is saying you have a usage-based contract. If you commit to X number of transactions, you're going to see Y dollars per transaction. My first question is to be, well, what if I do 100 instead of 10 transactions? What happens to that rate? And at least internally in Maxio, that's what we've seen, right? We are seeing people wanting to commit to longer terms when it comes to the volume they provide. And as a seller, if I can lock in more volume on a longer term, I'm happy to give a lower rate for that certainty. And as a buyer, they're very happy to see both a lower rate and more certainty as far as what that bill is going to be in the next year and the next year. Ray, what do you think is happening here? Because that 40% doesn't seem to foot with what I'm hearing with how people are scrutinizing external spend these days. But it's kind of a give and take.
Yeah, a couple things. During the SaaS period of second half 22 through first half 24, I saw a lot of companies saying, yeah, I'll reduce your monthly spend from 20K to 14K, bigger discounts, in consideration of a 2-year agreement. So I saw a lot of that. Hey, you love the product, you see the value, you need to take your cost down a little bit. I'm going to help you, and here's what you do in return. So that's one thing I saw a lot of, Alan. The other thing I would say here, and this is a lot of people in usage-based pricing are negotiating and saying, okay, you don't know exactly how much you're going to be using in year one. There's a ramp-up period, et cetera. So we know that 100,000 transactions is where you're going to be at full ramp. So we're going to do a 3-year contract that's going to include 300,000 transactions. It's going to be 60 the first year, 120 the second year, and maybe 120 the third year, right? So I've also seen that being traded off for long-term. But for the finance people in the audience, if you're doing that, make sure your revenue recognition infrastructure is solid. And that's not just how it's contracted. You need to seriously consider, well, the variable usage might truly be, I can only record as used. Even though they're committed to that 100K, if they only use 3K of that in month one, maybe you can only recognize revenue for the 3K. So make sure you know what your ASC 606 policy and revenue management infrastructure is.
Totally. Talk to your auditors, talk to your CPAs in-house, because there are some, there's a lot of nuance that goes into rev rec for usage-based billing. And, oftentimes, you may be able to straight line that 3-year agreement, but if it's a hugely significant part of your business, probably not. So you need to make sure that you've got that infrastructure to understand that daily rev rec, those daily transactions, in order to effectively recognize revenue and stay in compliance. That's what we got for y'all today as far as the results of this survey. Super interesting stuff. If you haven't downloaded and read the report, please do. Really interesting to look at and think about in retrospect compared to how you are operating your business. And it's also helpful for, I think, your go-to-market teams to understand what is the market seeing out there, because oftentimes when you're trying to change models here, it can be scary for the front lines, but seeing how much adoption it's getting is got to be really comforting for a lot of you in the audience. And as we think about it, it's time to rethink your pricing and billing strategy, right? Pricing and billing is a core strategic function. It's not just operational necessities, and it's a way that's going to help you drive growth and create a better customer experience. Your pricing model is your growth strategy, right? If you're not iterating on it, you're leaving money on the table. And one thing to take this even up a level, right? I always think of pricing as one of the best levers you can pull to drive enterprise value. And it's not just because it can, impact that customer experience in so many different ways, help to accelerate customer adoption, accelerate NRR. But the very simple reason for that is $1 of extra revenue we get on pricing. It's $1 of extra EBITDA you get which means that you take a multiple of that, no matter what metric you're choosing, and you are going to add significant value to the business with pricing shifts. Providing that transparency is critical. It's a competitive advantage. It helps to drive relationships. It helps to make those overage conversations so much easier. And it helps to even position yourself into talking about multi-year arrangements as you better understand, your customer better understands the ramp of their usage. And finally, as we hit on, you got to look at all of the variables. And the best performing SaaS companies are using data and not guesswork. They're leveraging benchmarks from companies like Ray, who are able to share what are other businesses in the industry doing. They're leveraging their own internal data to understand what is happening within their own customer accounts. And they're tying that back to their financial strategy to drive experimentation and continuous improvement. So that's where we come into play, both Benchmarkit and Maxio, right? Benchmarkit can help to provide you guys with real-time data, very interesting trends on the market, and help you understand what are the best performing SaaS businesses out there doing. And Maxio, we can help to provide that billing infrastructure that enables usage-based pricing, the metrics and reporting infrastructure that help you better understand how your business is performing with this shift. And then finally, of course, the revenue recognition to ensure that you don't get in hot water with your auditors. And we have the tools that help you stay compliant with ASC 606 when it comes to usage-based billing. So schedule a demo with us, see how you can turn your pricing into a growth strategy for your business, leveraging both usage-based pricing and the reporting on it. And similarly, check out Benchmarkit, talk to Ray, see the data that they're able to provide. It can be a huge driver of intelligence in moving your business forward. And with that, I just got to say thanks everybody for attending. Don't see any more questions left in the queue. But before I break, Ray, any last words from you?
No, just thank you. I'm going to be posting on LinkedIn about a lot of the findings that we have from this report. So, feel free to follow me. It's just Ray Rike on LinkedIn, and you'll be seeing more and more, hopefully, valuable insights into what we learned together. Thank you, Alan, for partnering with us on this.
Thanks, Ray. Nice hanging out today. And thanks, everybody in the audience. We hope you found this valuable.
Bye, everyone.